This trading strategy is based on ALMA, Arnaud Legoux Moving Average. I mixed ALMA and 3 exponential moving averages with special settings that nobody knows. Just make sure you watch this video until the end and let's get started. But before we start, if you like my contents, please support the channel by liking the video and subscribing to my channel if you haven't subscribed yet. Alright, in this trading strategy, we're gonna add 1 Arnaud Legoux Moving Average and 3 exponential moving averages. But don't worry if you're on the free version of TradingView, because I will teach you how you can have 4 moving averages on your chart. Alright, let's add the indicators. Here we click on indicators and we search ALMA, this one, Arnaud Legoux Moving Average, which is a built-in indicator on TradingView platform. Alright, this moving average that is added to the chart is ALMA, Arnaud Legoux Moving Average, which is an advanced moving average with special algorithm based on Gaussian filter that helps to reduce the noise and lag, and so we have a smoother and more responsive moving average in compared to other types of moving averages. We need to give it a small change in the settings so it will be suitable for the trading strategy that I want to explain. Here we go to the settings of the ALMA, and here for the length we set it at 8. We don't change anything else here, and then we go to the style tab and we change the color to white, and we also increase the thickness of the line so it will be better visible on our price chart. Alright, we're done with the settings of ALMA, and now we need to add 3 exponential moving averages. So here we click on indicators and we search ribbon, this one, moving average ribbon, which is a built-in indicator on TradingView platform. When we add this indicator, we have 4 moving averages that are added to the chart, but we need to change their settings. So here we go to the settings of the ribbon, and first here in the inputs tab, we remove one of the moving averages because we need only 3 moving averages. That should be exponential moving averages. So here for the type of the moving average, we set EMA for them. And then here for the first EMA, we set the length at 8. And for the second EMA, we set the length at 89. And for the third EMA, also we set the length at 89. For the second EMA, here for the source of calculation, we set it at high. And for the third EMA, we set it at low. For the first EMA, it should be based on close. Alright, now we need to change their colors. Here for the first EMA, we set the color to yellow. Here for the second EMA, we set the color to green. And for the third EMA, the color should also be green. And finally, we go to the style tab and we increase the thickness of the lines so they will be better visible on our price chart. Alright, everything is already set on the chart, and now let me teach you how you can find high probability buy sell signals in the market. But before that, I'm proud to announce that recently I published a book, The Art of Price Action Trading, which is a complete guide to price action analysis. The link is in the description and you can get it later if you want to master price action trading. Alright, getting back to our trading strategy. So here we have 2 green lines that are exponential moving average with length of 89, which one of them is based on high and the other based on low. And as you can see, they have created a channel on the chart. From now, we call it green channel. And then we have this white line, which is an Arnaud Legoux moving average with length of 8. And we have this yellow line, which is an exponential moving average with length of 8. Both of them have the same length, but you can clearly see that ALMA is more responsive to the price action and considerably with lower lag. And this will help us to identify exact buy-sell signals on the turning points of the market. Let me show how you can use these moving averages to find accurate trading signals. The trading strategy that I want to explain now is a reversal trading strategy, meaning we are trying to find reversal points of the market and then we want to find a good opportunity to enter a trade. Alright, here on this chart, we are trying to catch a reversal from uptrend to downtrend. And so this is actually a short position setup. When the market is in an uptrend, the price is above the green channel, and when the market is in a downtrend, the price is below the green channel. channel. So the crossing of the price above or below the green channel is important to us because it can be an early signal for reversal. Here you can see that the price from above the green channel went below the green channel, but this is not enough, and after that we want also the white line and the yellow line going completely below the green channel. For example, here you can see that the price went below the green channel, also the white line, but not the yellow line, and you can see that again the price advanced, and then here again you can see that the price went below the green channel, and after that the yellow line and the white line are also below the green channel. From here, when this candle is closed, you can see that the white line, the yellow line, and the price, three of them are below the green channel, and this is a signal for us that probably a reversal is happening, but this is not enough and we don't enter a trade here. We want a better entry and to be more confident and to say with higher probability that a reversal is happening. So we wait for a pullback. We use the white line and the yellow line to identify the pullback. We wait for the white line to cross above the yellow line. This shows that probably a pullback is forming on the chart, but we need to wait for a signal that shows end of the pullback. We wait for the white line to close back below the yellow line. When this happened and the white line is already closed below the yellow line, it tells us that probably the pullback ended and the price is going to decline more. So here the sell signal is confirmed and we could enter a short position at this point with the stop loss above the green channel and profit target at risk to reward ratio of 2. This was a short position setup. We could successfully identify reversal of the trend and find a good opportunity to enter a trade with high probability. Now let me teach you a long position setup. Here in this part of the chart, we are trying to catch the reversal from downtrend to an uptrend. As I explained earlier, when the market is in a downtrend, the price is below the green channel, and when the market is in an uptrend, the price is above the green channel. So we want a situation like this where the price from below the green channel crosses the green channel and goes above the green channel. And after that, we want also the white line and the yellow line to go above the green channel. You can see that from here, the white line, the yellow line, and the price, three of them are above the green channel. This is an early signal that probably a reversal is forming on the chart. Now we should wait for a pullback. We should wait for the white line to go below the yellow line. This shows that probably a pullback is forming on the chart, and this can provide a trading opportunity to enter a trade. In the next step, we should wait for a signal that shows end of the pullback. We wait for the white line to close back above the yellow line. When this happened, and the white line is already closed above the yellow line, which happened here when this candle was closed, this tells us that probably the pullback ended and the price is going to advance more. So here the buy signal is confirmed, and in practice we could enter a long position at this point with the stop loss below the green channel and profit target at risk to reward ratio of 2. You can see that this trade was also a profitable trade. Please pay attention that for decreasing our risk, we don't enter in the next pullbacks. We only enter a trade on the first pullback after we have all the explained conditions. You can still make profit in the next pullbacks which are happening inside the current trend, but that would be a trend following strategy, which is different from a reversal trading strategy, and it may need different measures for the moving averages, trade entry, stop loss, and profit target. So in this trading strategy, we only enter a trade in the first pullback. And another important point is that this trading strategy will not give you 100% guaranteed signals. No, this is not possible in reality, and losing positions are always part of the game, and you need to manage your risk properly. There is a risk management strategy that is called 1% rule, and it is one of the best risk management strategy that you can use. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it, because without a proper risk management strategy, you cannot become a consistently profitable trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.